If someone handed me $100,000 right now and said, invest this, here's exactly what I would do. Not what I'd tell you to do, I'm not a financial advisor, but what I would personally do with my own money in January 2026, with everything that's happening in the world right now. My name is Alex, and I've been thinking about this a lot lately. Because the honest truth? The markets feel unstable. Politics feel chaotic. And every time I open the news, there's another reason to be worried about money. So if you're sitting on cash right now, afraid to invest it, or you've got $100,000 burning a hole in your savings account and you don't know what to do, stick around. Because I'm going to walk through my exact allocation, my reasoning, and why I'm splitting my money the way I am. Let's be real about what we're facing right now. January 2026. We've got political volatility. We've got inflation concerns. We've got interest rates that have been all over the place. The S&P 500 has been on a roller coaster. Crypto's doing its usual insane thing. And every financial expert has a different opinion about what's coming next. Some people are saying recession. Some are saying bull market. Some are saying everything's fine, just buy index funds. Some are saying cash is king, wait it out. And here's the problem. Nobody actually knows. Anyone who tells you they know exactly what's going to happen is lying or delusional. So you're stuck. If you keep your money in cash, inflation is eating it alive, probably 3 to 4% per year. But if you go all in on stocks right now, you could watch 20 to 30% disappear overnight if things go south. This is where most people freeze. They do nothing. And doing nothing is actually a decision. You're deciding to lose to inflation. So here's what I would do instead. My investing philosophy in volatile times is this: protect the downside, participate in the upside. I'm not trying to get rich quick. I'm trying to not get poor while still letting my money grow. That means I'm splitting my $100,000 into 4 buckets. Each bucket has a job. Some protect me if things go bad. Some grow if things go well. And some do both. Bucket 1. Stability. 40% of my money. This is my sleep at night fund. Bucket 2. Growth. 30%. This is my participate in the market fund. Bucket 3. Opportunity. 20%. This is my take advantage of volatility fund. Bucket 4. Protection. 10%. This is my insurance policy fund. Let me break down exactly what goes in each bucket and why. Bucket 1. Stability. This is $40,000, 40% of my 100 grand. This money goes into 2 places. $20,000 into a high-yield savings account. Right now, these are paying around 4 to 5%. It's not sexy, but it's safe, liquid, and keeps pace with inflation. $20,000 into short-term Treasury Bonds, 6-month to 1-year T-bills, currently yielding around 4 to 5%, backed by the U.S. government. Why 40% here? Because if the market crashes tomorrow, I've still got $40,000 that didn't crash with it. I can sleep. I can breathe. I'm not checking my account in panic. This is boring. It's supposed to be boring. Boring is good when the world is chaotic. And here's the thing. This 40% gives me the emotional stability to be smart with the other 60%. When you know you've got a cushion, you don't panic sell when markets drop. You don't make emotional decisions. That's worth more than any extra return. Bucket 2. Growth. This is $30,000, 30% of my money. This goes entirely into low-cost, diversified index funds. Specifically, $20,000 into a total U.S. stock market index fund, like VTI or VTSAX. $10,000 into an international stock index fund, like VXUS or VTIAX. Why index funds? Because I'm not trying to pick winners. I'm buying the entire market. When you buy VTI, you own a piece of Apple, Microsoft, Amazon, and 3,500 other companies. If the US economy does well over the next 10 to 20 years, I do well. The international fund? That's my hedge. If the US underperforms, maybe Europe or Asia picks up the slack. Diversification across the entire world. Now here's what I know. This money might drop 20 to 30% in the next year. It might. And if it does, I'm not touching it. Because historically, every major dip has been followed by a recovery. If you zoom out, the line goes up. But I only put 30% here because I'm not gambling my entire future on the line goes up. I'm being measured. Bucket 3, opportunity. This is $20,000, 20% of my money. And this is where I take calculated risks. Look, I'm not going to play it completely safe here. I've already protected 80% of my portfolio. This bucket is where I actually put my research to work and take positions I believe in. This money is split into 3 parts. First, $10,000 into cryptocurrency. But I'm not just blindly buying Bitcoin. Here's my split. $6,000 into Bitcoin. It's the most established crypto. Institutions are buying it, and it's increasingly being seen as digital gold. It's volatile, but it's proven it can survive. $4,000 into Ethereum. Why? Because Ethereum isn't just a currency, it's a platform. Smart contracts, DeFi, NFTs, the entire Web3 ecosystem is being built on Ethereum. If blockchain technology actually becomes mainstream, Ethereum is positioned to capture that value. Is this risky? Absolutely. Could this go to zero? Technically, yes. But I've done the research, I understand the technology, and I think the asymmetric upside, the possibility of 3 times, 5 times, or even 10 times returns over the next decade, is worth the risk with money I can afford to lose. Second, $6,000 into sector-specific ETFs, but I'm going for sectors I genuinely believe are undervalued or positioned for the future. $3,000 into QCLN, the First Trust Nasdaq Clean Edge Green Energy Index Fund. I know everyone's bearish on green energy right now because of political headwinds, but that's exactly why it's a good opportunity. The long-term trajectory is clear. The world is moving toward renewable energy. Solar costs are plummeting, battery technology is improving, and governments worldwide are still pushing green initiatives. When sentiment shifts back, this sector will explode. I'm buying when others are fearful. $3,000 into SOXX, the iShares Semiconductor ETF. Semiconductors are the foundation of everything. AI, electric vehicles, data centers, phones, computers. We're in a chip shortage cycle, but long-term demand is only going up. This fund holds companies like NVDA, AMD, Intel, and Taiwan Semiconductor. These companies are building the infrastructure for the next decade of technology. Third, $4,000 into individual stocks. Companies I've researched extensively and have strong convictions about. $2,000 into NVIDIA. Yes, it's run up a lot already, but I think people underestimate how dominant they are in AI chips. Every single AI model needs NVIDIA GPUs. They're not just riding a trend, they're building the infrastructure that makes the trend possible. Data centers are buying thousands of their chips at $30,000 each. This isn't speculation. This is a company with a massive moat in a sector that's only beginning. $2,000 into Shopify. E-commerce isn't going away. Shopify powers over 4 million online stores, and they're taking a piece of every transaction. They're the picks and shovels play of the e-commerce gold rush. I don't need to predict which online stores will succeed. Shopify wins regardless. Plus, they're expanding into point-of-sale systems and challenging traditional payment processors. The growth runway is enormous. Now, why only 20% in this opportunity bucket? Because even though I believe in these picks, I'm intellectually honest enough to know I could be wrong. Markets are unpredictable. My research could be flawed. Sentiment could shift. That's why this is only 20%. If I'm right, it significantly boosts my returns. If I'm wrong, I still have 80% of my capital protected and growing steadily. This is calculated risk-taking. I'm not gambling. I've done the research. I understand what I'm buying and why. But I'm also not delusional. I know this bucket could underperform or even lose value. That's the price of seeking higher returns. Here's my rule. Never put money into bucket 3 that you can't afford to lose completely. This is not your emergency fund. This is not money you need in the next 5 years. This is long-term, high-conviction, calculated risk money. Bucket 4. Protection. This is $10,000, 10% of my money. This goes into gold. Either physical gold, a gold ETF like GLD, or fractional gold through an app. Why gold? Because it's insurance. When everything else is falling apart, stocks crashing, bonds uncertain, crypto imploding, gold historically holds value. It's been valuable for 5,000 years, and it'll probably be valuable for another 5,000. I'm not expecting gold to make me rich. I'm expecting it to protect me if everything goes wrong. It's my insurance policy. You don't buy insurance hoping to use it. You buy it hoping you never need it. So here's the complete picture of my $100,000. $40,000, 40%, stability, high-yield savings and Treasury Bonds. $30,000, 30%, growth, index funds, U.S. and international. $20,000 to 20%, opportunity, crypto, sector ETFs, and individual stocks. $10,000 to 10%, protection, gold. 40% can't lose significant value. 30% participates in long-term market growth. 20% takes advantage of opportunities. 10% protects against disaster. This isn't perfect. There's no such thing as perfect. But it's balanced. It lets me sleep at night while still growing my wealth. Now here's what's going to happen. Some of this will go down. Probably the growth and opportunity buckets. Markets will be volatile. Crypto will swing wildly. I'll see red numbers. And I'm going to do nothing. Because I built this portfolio knowing that would happen. The stability bucket keeps me calm. The protection bucket gives me insurance. And the growth bucket? That's a 10 to 20-year play. I'm not checking it daily. Volatility isn't failure. It's normal. The people who lose money are the ones who panic and sell at the bottom. I'm not doing that because 80% of my money is either stable or protected. You might be thinking, but Alex, what about the political situation? What about the election cycle? What about all the uncertainty? Here's my take. I can't control politics. I can't predict what governments will do. What I can control is building a portfolio that survives regardless of who's in charge. Stability bucket? Survives political chaos. Growth bucket? Long-term play regardless of short-term politics. Protection bucket? That's literally why it exists. I'm not betting on any political outcome. I'm betting on diversification and time. So that's what I would do with $100,000 right now. Not what everyone should do. Your situation is different. But this is my personal answer to the question everyone's asking. What do I do with my money when everything feels uncertain? You build a portfolio that can handle uncertainty. You protect what you can't afford to lose. You grow what you can afford to wait on. You take calculated risks where the upside is worth it. And then you stop checking your accounts every day. You turn off the financial news, and you live your life. If this breakdown helped you think through your own investing strategy, hit that like button and subscribe. And drop a comment telling me, if you had $100,000 right now, what would your allocation be? I read every single comment, and honestly, I want to hear what you'd do differently. Thanks for watching. I'll see you in the next one.